In the previous video, I mentioned that investors value recurring revenue more than one-time revenue. But why do they do so? There are 4 reasons. Firstly, stability. If most of a company's revenue comes through recurring revenue contracts, it is affected less by business cycle fluctuations. It will have most of its revenue intact even in a downturn. Secondly, with a recurring revenue contract, a company has to pay for acquiring each customer just once. And if the customer sticks around for a long time, the company can build a wonderful business with low overall customer acquisition costs. The third reason is predictability. Recurring revenue is predictable. It is much easier to model, which has 3 consequences. Firstly, being easier to model implies that a company with recurring revenue will find it much easier to control its expenses and reach break-even. This is especially helpful in lean times when capital isn't easily available to cover losses. Companies that don't have recurring revenue can find it very hard to model their businesses and exert the same fine-grained control over expenses to reach the break-even point in lean times. Secondly, being able to predict your revenue is a key prerequisite to raising debt. Otherwise, as long as your revenue remains hard to predict, you will also find it hard to raise debt. And debt is a much cheaper form of capital than equity. So a company with recurring revenue can access cheap capital much earlier than a company that doesn't have recurring revenue. Having recurring revenue can also result in having very low working capital needs. Working capital is capital you need to cover expenses while you wait for your receivables to clear, or capital that is stuck in inventory that is waiting to be sold to customers. In most recurring revenue scenarios, it is possible to ask your customers to pay in advance before they use your product or service. If you can do so, it means that your receivables will be negative, which means that you will not wait around to receive money from customers. Instead, your customers will wait around to use your product or service after paying you. If you can achieve this, it is a tremendous superpower to have in a business. Companies that have negative working capital need much less equity capital to scale and grow. The difference can be immense. A business with negative working capital may only need half the equity capital to grow to the same size as it would with a positive working capital cycle. Most trading and manufacturing businesses are constrained in their growth by working capital. If they can release their working capital, they can sometimes grow their revenue by many times. These reasons together result in recurring revenue businesses being valued at higher multiples than one-time revenue businesses. To summarize this in one line, recurring revenue is more stable, so such businesses have lesser risk than one-time revenue businesses. And if you understand discounted cash flow valuation, lesser risk means a lesser discount rate, which results in a higher valuation multiple. Let's take a simplified example to explore just how valuable recurring revenue could be. Suppose you start a SaaS business today in 2021 and you get one customer, just one customer who finds your product valuable enough to agree to pay you $100 per month till the end of time. Just $100 per month, nothing more, nothing fancy. Also, for the simplicity of our example, assume that you have absolutely no costs to serve or support this customer. So what is the total value of this customer to you? How do you think about this? If you keep adding up $100 for an infinite number of months, the value will also be infinite. But notice that if you get any dollars today, you can deposit them in the bank so that they will grow in value every year. This also means that if you get $100 next year, they will be less valuable than the $100 that you receive today. Therefore, you must discount the $100 you will receive in the future to get their equivalent value today. And the further away the payout, the lesser its value. This is the principle behind the discounted cash flow valuation method, or DCF. Applying DCF to our example here is quite easy because we are receiving a fixed payment till the end of time. Such a payment structure is called a perpetuity. The DCF method tells us that the value of a perpetuity today can simply be calculated by dividing the fixed payment amount by the interest rate that you would get by depositing the money today in a bank's certificate of deposit or fixed deposit. Now, the average interest on a US bank certificate of deposit today is 0.32% annually. So applying the perpetuity formula, the value of this one customer paying you $100 per month is $375,000, more than $1/3 of $1,000,000. So if you just get 3 such perpetual customers, you would have built a revenue line worth more than $1,000,000. Recurring revenue is insanely valuable. Now, don't be misled by the simplifications in this example. It would be very tough to retain a customer till the end of time. Forever is a long time. It is also clearly wrong to assume that there would not be any support costs in the real world. Additionally, the interest rates may increase in the future and decrease the value of this perpetuity. You may also argue that we should use some other interest rate instead of the average CD or bank FD rate. All these are fair arguments. But the point here is not to arrive at a good estimate of the value of this perpetuity, but rather to understand the factors that affect its value. So, what you should take away from this simplified example are 2 points. Firstly, recurring revenue can be surprisingly valuable. As a practical matter, if you are thinking of building a SaaS startup, today SaaS is such a well-established thesis that even if you can get 15 to 20 customers that love your software and buy a subscription of $100 every month, it wouldn't be a stretch to raise money at the valuation of a few $1,000,000. Secondly, note that interest rate is in the denominator of the perpetuity formula. This is the case with all DCF valuation formulas, and this is the reason why stock prices fall when interest rates rise, and why stock prices rise when interest rates fall. Because interest rate is in the denominator in all valuation calculations in the DCF method. To understand why interest rate is in the denominator in DCF, you will need to read up on how this method is derived. There is a link to an article in the description below if you are interested. For now, just understand that DCF is the most fundamental valuation method in finance, and it is derived from very basic math without fancy assumptions, just from the definition of interest rate and time itself. So you should trust that DCF has got at least the fundamentals of valuation right, like the impact of interest rate on valuation. Now that you have learnt about recurring revenue and how valuable it could be, next, let's discuss why SaaS is an evergreen opportunity. Hey there, I'm KJ Saxena, founder of Relentless VC. The video you just watched is part of the Venture Capital and Entrepreneurship Specialization, which is available absolutely for free on relentless.ventures. Go check it out. If you're a tech startup founder and want to raise money from us, you should apply on our website. Lastly, if you like this video, do subscribe and share it with your friends.